Imagine a world where your financial decisions are not dictated by market whims or fleeting trends, but by timeless principles that have guided the most successful investors through centuries of economic change. Today, I invite you to explore these principles, not as abstract concepts, but as practical tools you can apply to manage your money like the top 1%. Imagine you're building a machine, a beautiful, well-functioning machine that can operate in any environment. That's how I think about managing money. Every part of that machine should serve a function. Some parts will do great in sunshine, others will shine in the rain. The goal isn't to have every part performing its best at the same time. The goal is to make sure that no matter what happens in the environment, your machine keeps moving forward. That's what true diversification is. Most people think diversification means holding a bunch of different assets. They buy a few stocks from different sectors, maybe throw in a bond or two and call it a day, but that's not diversification. That's decoration. If all the assets you hold go down when the market goes down, you're not diversified, you're exposed. Real diversification means holding assets that are fundamentally uncorrelated, meaning they don't all respond the same way to the same forces. Let's break that down in a way that's intuitive. Think about what drives asset returns. Stocks, for example, tend to go up when the economy is strong and inflation is low. Bonds might do well when inflation is falling and growth is slowing. Commodities often surge when inflation spikes. So if you put your money in all of these in the right proportions, what you're doing is creating balance. You're not betting on one outcome, you're preparing for multiple outcomes. The markets are filled with noise. It's easy to be seduced by what's hot: tech stocks booming, real estate climbing, crypto making headlines. But if you're only invested in one type of environment, you're essentially making a big bet that that environment will continue. That's risky, and history shows us that no environment lasts forever. Booms turn into busts, inflation rises and falls, interest rates shift, governments and central banks intervene, cycles rotate, and each of those events impacts different assets in different ways. Here's the thing, you're not going to predict these events perfectly. Nobody can. I've spent my life studying markets, economies, cycles, systems, and I can tell you, even the best investors are wrong a lot. That's why diversification is not just a strategy, it's a form of humility. It's saying, I don't know exactly what's going to happen, so I'm going to prepare for many possibilities. When assets are uncorrelated, they behave independently of each other. One might go up when another goes down, and when you combine them, the total volatility, the ups and downs of your overall portfolio goes down, while your expected return stays relatively stable. That's the magic of it. You're not sacrificing return, you're reducing risk. And if you can reduce risk without reducing return, your compounded returns over time increase. That's how wealth is built sustainably. It's also important to realize that correlations between assets aren't fixed. They change depending on the environment. In normal times, stocks and bonds might move in opposite directions. But in a crisis, correlations tend to rise, everything goes down together. That's why you need to look beyond traditional categories. Think globally. Think across currencies, interest rates, commodities, geographies. Ask yourself, what are the forces that will drive each of these, and how do those forces interact? For example, if inflation takes off, what happens? Cash loses purchasing power, bonds suffer, but real assets like gold or commodities tend to perform well. If growth slows and deflation becomes the threat, bonds might do well, while commodities could collapse. The key is to hold a combination that can thrive across a variety of conditions. That's how you become resilient. This approach isn't flashy. It doesn't give you the thrill of riding a bull market all the way to the top, but it gives you something more valuable: durability, peace of mind, the ability to sleep at night knowing that whatever storm hits, your financial ship isn't going to capsize. And in the end, that's what managing money is really about. It's not about winning big once. It's about staying in the game consistently, intelligently, and with balance. It's about building a machine that works not just in good times, but across the full arc of the economic cycle. That's the kind of approach the top investors take, not because it sounds good, but because it works. The economy moves like a machine, pulsing, cycling, expanding, and contracting. And if you want to manage your money like those who are consistently successful, you must understand how that machine operates, not just superficially, but deeply. Because everything that happens in the market, asset prices, investment returns, financial stress, it all comes back to where we are in the economic cycle. If you don't know what part of the cycle you're in, you're effectively flying blind. Think of it this way: the economy is driven by human behavior, and human behavior is remarkably consistent over time. People borrow, spend, invest, and save based on incentives, interest rates, inflation, wages, debt levels, and expectations. These behaviors aggregate to form patterns. Those patterns create cycles, and while the details change, the structure is the same. We go from periods of expansion to contraction, from optimism to pessimism, from boom to bust, and back again. At the core of these cycles is credit. Credit is the fuel of the economy. When borrowing is easy, spending rises, businesses expand, asset prices go up, and the economy grows. But this kind of growth is borrowed from the future. Debt must be repaid. When the burden becomes too high, spending slows, defaults rise, and the economy contracts. It's predictable if you understand the mechanics, and yet most people are surprised every time it happens. The long-term debt cycle operates over decades. It's what leads to major shifts, like the kind we saw in 2008 or again in 2020. In between, there are shorter cycles, business cycles, that last around 5 to 10 years. These are driven by interest rate changes, monetary policy, and shifts in credit demand. When central banks lower interest rates, borrowing becomes cheaper. People and companies borrow more, spend more, invest more. That fuels growth, but eventually the economy overheats, inflation rises, the central bank tightens policy, interest rates rise, borrowing slows, spending falls, and the cycle turns. This is not philosophy, it's mechanics. If interest rates are low, people take on more debt. If they take on more debt, they have more money to spend. That spending becomes someone else's income. That income supports more borrowing. It's a reinforcing loop until it isn't. When debt levels become too high relative to income, people can't keep borrowing. They start cutting back. Asset prices, which had been propped up by easy money, start to decline. People feel poorer, they spend less, the cycle reverses. Understanding this gives you a huge advantage. When you know where you are in the cycle, you can position yourself accordingly. You don't need to guess what the markets will do tomorrow. You can prepare for what they're likely to do over the next phase of the cycle. Are we in a period of easy money and asset inflation? That tells you something. Are we in a tightening environment with rising rates and credit contraction? That tells you something different. Each part of the cycle rewards different behaviors. Most investors lose not because they lack intelligence, but because they ignore the cycle. They extrapolate the recent past into the future. When markets have been going up, they assume they'll keep going up. When they're going down, they assume the worst is yet to come. But the reality is, the cycle turns. It always does. That's not optimism. It's historical truth. This perspective also helps you manage risk. It tells you when to be cautious and when to be bold. It helps you understand that no asset is inherently good or bad. It's good or bad depending on the environment. Stocks can be great in a period of growth and low inflation, but dangerous when inflation is rising and liquidity is drying up. Bonds can be safe in a deflationary slump, but devastating when interest rates rise sharply. If you don't understand the cycle, you can be holding the right assets at the wrong time. Now, no one can predict exactly when a cycle will turn, but you can watch the signs: debt levels, interest rates, inflation, employment, policy moves. You can look at the indicators and ask, are we early in the cycle or late? Are we transitioning from one phase to another? That awareness allows you to shift your portfolio, your expectations, your strategy. It gives you context, and context is everything. Managing money without understanding the economic cycle is like sailing without knowing the weather. You might get lucky for a while, but eventually a storm will come. The winds will shift, and if you're unprepared, you'll be caught off guard. But if you've studied the patterns, watched the signals, and built a strategy that respects the rhythm of the cycle, you'll not only survive, you'll thrive. That's how you play the long game. That's how you manage money with clarity, foresight, and resilience. Not by reacting to headlines, but by understanding the deeper forces at work. The economy is a machine. Learn how it moves, and you'll never look at investing the same way again. Managing money well isn't about chasing the highest returns. That's a trap most people fall into, especially when markets are booming. It feels good to ride that wave, to see numbers going up, to believe that you've figured it out. But what separates the consistently successful from the rest isn't how high they can fly in good times. It's how well they can navigate the bad times without losing what they've built. That's why balancing risk and return is everything. Every investment decision involves a trade-off. You're giving up something today, usually liquidity or certainty, in exchange for a potential gain tomorrow. But that gain is never guaranteed, and the path to it is almost never smooth. So the question isn't just, how much return can I make? The better question is, how much risk am I taking to get that return? And is that risk worth it? Most people underestimate risk. They confuse volatility with opportunity. They assume that what's been going up will keep going up. They load up on assets that have performed well recently, thinking they're making smart moves. But they're not looking at the downside. They're not asking, what happens if this doesn't work out? What happens if the environment changes? What happens if I'm wrong? You have to start from the assumption that you will be wrong sometimes. No matter how smart you are, no matter how much analysis you do, you can't predict the future perfectly. The world is too complex, surprises happen. So the first principle in managing risk is humility. You build your strategy not on being right all the time, but on surviving and thriving even when you're wrong. That's where balance comes in. You can think of a portfolio like a seesaw. On one side, you have assets that do well in one environment, maybe equities in a growing economy. On the other side, you hold assets that do well when growth slows or inflation rises, maybe bonds or commodities. The goal is to balance the seesaw so that it doesn't tip violently when conditions change. You want it to stay steady, producing solid returns without wild swings that can wreck your confidence or your capital. This isn't about playing it safe or avoiding risk altogether. Risk is essential. Without taking on some risk, there's no reward. The key is to take calculated risks, ones where the potential upside justifies the downside and where the downside won't wipe you out. That's how professional investors think. It's not about hitting home runs. It's about consistently getting on base, protecting your downside, and compounding over time. One of the most powerful tools in balancing risk and return is diversification, not just across asset classes, but across different return drivers. What you're really trying to do is combine assets that respond differently to the same conditions. If interest rates rise, for example, your bonds might fall in value, but maybe your inflation-protected assets or commodity positions rise. That kind of balance smooths your overall returns. It means that no single economic scenario dominates your portfolio. When you achieve this kind of balance, something remarkable happens. Your overall risk level drops, even if your returns stay strong. That's because the assets hedge each other. The volatility of the whole becomes less than the volatility of the parts. And when you reduce your risk without reducing your expected return, your long-term performance improves dramatically. Compounding works better when you avoid large losses. The biggest mistakes people make come from failing to understand this. They get greedy in bull markets, take on more leverage, concentrate their bets, and overexpose themselves to one scenario. Then, when the cycle turns, and it always turns, they lose more than they can handle. It's not that they didn't have good ideas. It's that they didn't respect risk. They forgot that the same leverage that amplifies gains will also magnify losses. Balancing risk and return isn't exciting. It doesn't make headlines, but it works. It gives you staying power. It keeps you in the game when others are forced out. And over the long run, that's what really matters, not how much you make in a good year, but how much you keep when things go bad. So don't ask how much return you can make. Ask how much risk you're taking to make it. Measure that risk, understand it, and make sure you're being paid enough to take it. Because in the end, the real edge isn't in predicting the next move, it's in being prepared for anything. That's how you build wealth that lasts. That's how you create something sustainable. The world never stops changing, markets shift, economies evolve, new technologies emerge, old rules break, new ones form. If you're managing money, whether for yourself or others, and you're not constantly learning and adapting, you're falling behind. It's as simple as that. What worked yesterday won't necessarily work tomorrow. And what you think you know might already be outdated. The ability to adapt isn't just useful, it's necessary for survival. Most people approach investing as if they can figure it all out once and then coast. They read a few books, watch some content, follow some market pundits, build a strategy, and then expect it to perform in all conditions. But that's not how it works. The markets are complex, dynamic systems. They're driven by ever-changing combinations of human psychology, policy decisions, innovation, and global events. If you're not continuously updating your understanding, you're operating with stale information in a fresh environment. You don't need to reinvent your philosophy every week, but you do need to stress test it constantly. What assumptions is it built on? Are those assumptions still valid? If not, what needs to evolve? The best investors are those who can hold two ideas at once: conviction and openness. They stay rooted in core principles, but are always scanning for new insights, new risks, and new realities. They know that what matters most isn't being right, it's being right enough of the time to stay in the game and grow over the long term. Learning isn't just reading more or collecting more data. It's refining your mental models. It's observing how the world responds to different forces and using those observations to make better decisions. It's seeking out feedback, especially from failure, because failure teaches faster than success. When something doesn't go your way, don't just move on, study it. Ask, what did I miss? What bias clouded my thinking? What indicator did I ignore? That's where growth happens. The truth is, the markets don't care about your opinion. They don't care about your hopes, your goals, or your past successes. They respond to reality, and your job is to align yourself with that reality as accurately as possible. But reality doesn't sit still. It moves, it morphs, it contradicts itself. So you need to constantly recalibrate, not emotionally, not flipping your strategy every time there's volatility, but intellectually, with humility and discipline. This process also means embracing discomfort, because learning often involves letting go of ideas you were attached to. It requires questioning what you've always believed, and that's hard, but clinging to outdated thinking is riskier than adapting. Markets punish rigidity. They reward those who can evolve. You also need to challenge your own perspective. Seek out information that contradicts your view. Listen to people who think differently, not to agree, but to understand. Surrounding yourself with yes men or echo chambers might feel good, but it won't make you sharper. What sharpens you is tension, respectful tension between competing ideas. That's where innovation comes from. That's where clarity emerges. Adaptation isn't reactive, it's proactive. It means preparing before the environment demands it. The best investors don't wait for the storm to hit before they secure the foundation. They build robust systems that can withstand a range of scenarios, not because they know which one is coming, but because they know they don't know. That mindset of thoughtful preparation and openness is what creates resilience. One of the greatest advantages you can have in any domain is the willingness to be a lifelong learner, not because you're lacking something, but because you understand that excellence is a moving target. There's always more to understand, always another layer to peel back. That mindset keeps you humble, it keeps you curious, and curiosity is one of the most valuable assets you can hold because it keeps you from getting stuck, from getting lazy, from becoming outdated while the world moves on without you. This isn't about chasing every trend or trying to predict every move. It's about building a process that evolves as you evolve, one that incorporates new knowledge, tests old assumptions, and adapts when the facts change. The people who thrive in this world are those who see change not as a threat, but as a signal to pay attention, to learn, to grow. In the end, managing money well is a never-ending journey of discovery, and the more willing you are to keep learning, to keep adapting, the better your odds become, not just of achieving better returns, but of understanding how the world really works. And that understanding, compounded over time, is the foundation of lasting success. In conclusion, managing your money like the top 1% isn't about secret formulas or exclusive opportunities. It's about adhering to principles that withstand the test of time. By embracing diversification, understanding economic cycles, balancing risk and return, maintaining emotional discipline, and committing to continuous learning, you position yourself not just to preserve wealth, but to grow it meaningfully. Remember, financial success is less about timing the market and more about time in the market, guided by sound principles and informed decisions.